Hello, good morning, everybody, and welcome to today's presentation on discovering 1031 Exchange. My name is Jeff Stechmann. I'm the Eastern Regional Manager for our Asset Exchange Company. Before we get started, just want to let everybody know how we're going to handle today's presentation. Don't think that you have to write every single thing down. Today's presentation is actually being recorded, and you will receive a link to today's recording if you want to refer back to any of the topics. And then some of the topics that we're going to cover today, I have in just like a single page PDF form. I'm going to email those out to everybody that's on the line today. If you want to refer back to some of the topics, and the email will be in a format that if you're a realtor on the line today and you want to be able to send something out to a potential client of yours, or a client of yours that has a 1031 exchange need, it'll be really easy. You can just forward it right on to them. And then as far as questions go, I'm going to open the floor up to questions at the very end of the presentation, because now I find a lot of times if you do have a question, most often it'll be covered in an upcoming slide. But if not, again, at the end is when I'll open the floor up to questions. There's a box on the right-hand side of your screen that says questions. Right there is where you'd want to type it in. And then today's presentation is going to be worth 2 hours of continuing ed for Florida realtors. Now, hopefully when you registered for the class today, you gave me your Florida real estate license number. It either begins with an SL or a BK. Hopefully you included that as well, along with the number. Sometimes people give me their MLS numbers, but I actually need your Florida real estate license number, because I have to take that along with your first and last name and manually upload it to the state of Florida in order for you to get your 2 hours of continuing ed. And the other thing with today's presentation, in order for me to be able to give you those 2 hours of continuing ed, you have to be on the presentation for the entire length of the duration of the webinar. If for some reason you have to log off and you're not on for the entire duration, unfortunately, I'm going to be unable to give you those 2 hours of continuing ed. The state requires that you participate for the entire length of the webinar. So it looks like we had a few people join a few minutes late. So again, my name is Jeff Stechmann, Eastern Regional Manager with Asset Exchange Company. Kind of give you all some information about myself. I've actually been in the business for 26 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I've actually lived in Florida. I live in the Tampa area. I've lived in Florida for 23 out of those 26 years. And, as long as I've been doing this, I've seen the really good times in the real estate industry. And boy, I've seen the really bad times, and hopefully we never have to experience those bad times ever again. Right now the real estate industry is just booming. I mean, everybody that I talk to throughout the entire United States just tells me how great of a market is right now. At least if you're a seller. Now, if you're a buyer, that's a different story, because it's really hard to find properties. Because they're selling so fast. But it's great news for everybody in the industry. Hopefully, we can keep up this pace for the remainder of the year. Now, let me give you all some information about the company. So we're actually an asset exchange company again. And, we've been in business since 2006. And over the course of our existence, we've done about 40,000 1031 exchanges. So it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, now QI for short. Now, depending where you live, other terms you may hear people refer to is an accommodator. Another common term is a facilitator, or just simply an intermediary. But in our part of the country, people just call us QIs. And, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. Well, we hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. And we're going to talk about that in more detail in the next few minutes in some upcoming slides. Now, word of caution about QIs. It's amazing in today's heavily regulated real estate industry that at least on a national level, there actually is no agency that oversees this. There's no federal agency that oversees this. What exactly does that mean? Well, what that means is anybody out there can be a QI, right? There's no type of requirements you have to have any type of E&O insurance. There's no type of requirements that you have to have any type of bond. There's no guidelines on where you hold the proceeds, the type of funds you hold the proceeds. It's a really scary thought when you sit down and think about it. So, if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Now, the great news when you deal with us, right? Well, we're actually based out of California. Our home office is in San Francisco, and because we're California based, well, the state of California actually has a state agency that's referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. That's all overseen by that Franchise Tax Board, which is great for anybody that deals with us in California, right? But anything that we do nationwide, because we do 1031 exchanges in multiple states, all throughout the United States. Well, that Franchise Tax Board has oversight in any file that we work on, any exchange that we work on, because, as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on. So you do have some assurances, when you work with us. And as far as our ownership goes, we're actually owned by two gentlemen. Now, they've been in the 1031 exchange business specifically for like 20 plus years. One of which is actually a tax attorney. Now, his name is Adam Skarsgård. Now, Adam is actually considered like a 1031 exchange expert. He's been called upon to testify as an expert witness in tax court, as a expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited by the IRS, we would actually provide free audit support. All right? We'd work hand in hand with the client's CPA, helping to defend the audit. And it primarily would be done by our tax attorney, Adam Skarsgård. So another great reason to deal with us, right? Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around for like close to 100 years. It really started back in the 20s with farmers. And it was pretty simple back in those days, the way exchanging kind of worked. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm, and he wanted my farm. So all we did is just swap farms. And it was really that simple back in those days. But kind of our modern day exchanges, the format that we follow today, well, that was started back in 1979. All right, there was a gentleman that by the name of T.J. Starker. Now, Mr. Starker lived in California, and he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did is over the course of the next few years, he went out and bought various properties with those exchange credits. So that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. So if anybody on the line today has ever heard of the term a Starker exchange, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs I don't know, they've been in the business for 40, 50 years. They still refer to a 1031 exchange as a stalker exchange. So, yeah, occasionally you will hear that term pop up, but again, that's where it comes from, TJ Stalker's last name. Now, when we talk about 1031 tax deferred exchange, right? That name is actually derived from Internal Revenue Code section 1031, right? And the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Now, where the code states that property held for productive use in a trade or business. So you can do a 1031 exchange, okay, on any type of real property that you use in your trade or business. All right, I'll give you guys an example. We did an exchange for a gentleman. Now, he owned a daycare center, all right, so he was using that real property for his business. So what he did is he sold the business, sold the real property in a 1031 exchange, all right. And then what did he buy as a replacement? Well, in his case, he went out and bought another daycare center. So again, any type of real property that you use in your trade or business, you can sell that real property in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business. All right, now the next part of the code where it states for investment. So for investment could be something as simple as, let's say you own a single family residential home and you hold that for investment. Well, how do you hold that for investment? Well, it's a rental property, right? Well, you can take that rental property, you can sell that rental property in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, like kind property. So what exactly is like kind property? So like kind property is any type of real property that you use in your trade or business or that you hold for investment. You can sell that in a 1031 exchange, and you can replace it with any other type of like kind property, which is any type of real property that you use in your trade or business or that you hold for investment, right? So just because you own that single family residential home, right, you own that for investment, that rental property, when you sell that in a 1031 exchange, you don't have to replace it with another single family. Now you can if you want, by all means, right? But you could even replace it with a condo, a townhome, vacant land. You could replace it with a duplex, a fourplex, a commercial strip shopping center. Okay, a downtown commercial office building in any metropolitan area, major city in the United States. Okay, it doesn't matter if it's residential or commercial or residential. It doesn't even matter if it's your trade or business or investment. Everything is interchangeable. Okay, you could sell a property that you use in your trade or business, and then you can buy replacement investment property. Okay, everything is intermingled. Residential to commercial, investment to property using your trade or business. All of that is considered one and the same. Okay, you just whatever you're selling, you got to make sure whatever you're selling, you're using that property in your trade or business, or you're holding it for investment. And whatever you're replacing it with, you also are going to use that property in your trade or business, or you're going to hold it for investment. All right, and those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands. Okay. Now, property in Puerto Rico is actually excluded from that number. All right. Reason being, I think Puerto Rico is under a different tax structure than we are here in the States, and that's why property in Puerto Rico is excluded from 1031 exchange. All right. So if anybody on the line has ever heard of the term a like kind exchange, well, that's where it comes from. Okay. It comes from that part of the code that talks about like kind property. All right. Florida realtors. All right. In Florida, the standard real estate contract that every realtor uses in the state of Florida, it's referred to as the FAR bar. In that real estate contract, all right, there's already standard 1031 exchange language in the contract, all right? It's in section 18 and it's item N in section 18, all right? In that language, they actually refer to a 1031 exchange as a like kind exchange, okay? So again, you'll hear that pop up every now and then, but that's where it comes from. It comes from that part of the code that talks about like kind property, okay? Now, why do investors exchange? Well, the single most obvious reason that we see is for tax deferment. All right. Now, typically when you sell real property, all right, if you have any gain in the property, all right, on average, about whatever that gain is, goes towards paying taxes. So that's the single most reason that we see investors doing 1031 exchanges is to defer those taxes. But what are some of the other things that we see? Well, next bullet I call it buy more property. So with exchanging, right, one of the rules to exchanging, the replacement property that gets purchased in the 1031 exchange, that purchase price must be equal to or greater than whatever the sales price was on the property that was sold, the relinquished property. So what an investor will do is they utilize the tax savings, all right, of not having to basically cut that check when they do a 1031 exchange, and they utilize that as leverage to go out and buy themselves a better property. All right, hopefully it's going to be a higher dollar property, okay, and also hopefully it's going to be a higher income producing property. All right, all by doing a 1031 exchange. Now, what are some of the other things that we see? Well, diversification and management relief is another thing that we see investors using 1031 exchange for. You know, with exchanging, you're not even limited to how many properties you can sell in an exchange and how many properties you can purchase in an exchange, right? You could sell one property, you could buy one replacement property, or you could even sell multiple properties in an exchange and buy a single property, or you could sell one property, you could buy multiple properties, all right? It doesn't matter, all right? What matters, I'll say it again, all right? As long as what you're selling, you're using it in your trade or business, so you're holding it for investment, and as long as what you're replacing it with, you're going to use that property in your trade or business, so you're going to hold it for investment. All right, so geographic diversification is something that we see investors using 1031 exchange for. I'll give you guys an example. Let's say you own an investment property. Let's say it's located in California. Now, California has some of the highest property values in the entire country. I think where our home office is located in San Francisco, I think the average sales price in San Francisco has now actually exceeded the average sales price of what property costs in New York. I think it's the highest in the country now. San Francisco is. So, all right. So you own that investment property in California, right? Now you sell that investment property in a 1031 exchange. You defer your taxes, right? Now instead of buying a replacement property in California, you say, okay, maybe I'll buy one replacement property somewhere here in Florida, and maybe I'll buy an additional replacement property, let's say maybe somewhere in Texas, and maybe I'll even buy a third property, an investment property, let's say somewhere in Ohio. Because why? Because you don't want to be so tied in to one particular real estate market because, hey, who knows? If our market here in Florida starts to go down again, hey, well, at least you have that other property in Texas and that additional property in Ohio. Hopefully those real estate markets would not be experiencing the same downturn that we would be experiencing here in Florida. All right. What are some of the other things we see? Well, management relief is another thing that we see investors utilizing 1031 exchange for. I'll give you guys another example. I have a guy that lives in New York, right? He owns 4 investment properties, 4 rental properties. Now, what he'd like to do is he'd like to retire and he'd like to move to Florida. But guess what? He doesn't want to manage property anymore. So his ultimate goal is he'd like to sell all 4 of those rental properties in one 1031 exchange, all right, defer all of his taxes. And then in his case, he'd like to maybe find like a small apartment complex somewhere here in Florida that has some on-site management. Because why? He doesn't want to manage property anymore, right? He wants to just retire and he wants to sit back and he wants to collect a check every month. Well, 1031 exchange is perfect for somebody like him. All right. Now, what are some of the other things we see? Well, investors will actually use 1031 exchange as an estate planning tool. Now, this is something that it doesn't really get talked about that often, but it's a really great benefit with 1031 exchange, right? If y'all remember anything about today's class, remember this, okay? The whole estate planning tool. All right. So with 1031 exchange, right? You're not even limited to how many times you can do a 1031 exchange, right? I can buy an investment property today, hold on to it for a period of years, sell it at some point, do a 1031 exchange, defer my taxes, buy another investment property in that exchange, hold on to that for a period of years. At some point, sell that, do another 1031 exchange and defer my taxes again. And I can buy and then go out and buy another investment property. And I can keep doing that over and over and over through the entire course of my life, right? My entire lifetime, I can keep just buying investment properties, deferring, doing 1031 exchange, deferring and deferring and deferring. Okay, now what happens when I die, all right, when I pass on, if I have any heirs that inherit my property, okay, my heirs are going to get a benefit that's referred to as a step up in basis. And basically what that means is whatever the value of the property is when they inherit it, that's their basis. That's their starting point. Okay. All of those deferrals that I would have done over the course of my lifetime, guess what? They go away and no one ever has to pay the taxes. All right. All right. That's a really great aspect of 1031 exchange. Again, that doesn't really get talked about that often. Now, what's the flip side of that, right? Well, I just mentioned you're not limited to how many times you can do a 1031 exchange, right? Buy an investment property today, hold on to it for a period of years, sell it in a 1031 exchange, defer my taxes. Hey, buy another investment property, hold on to that for a period of years, sell that in a 1031 exchange, and buy another investment property, right? Now, let's just say the next time that I go to sell, I say, you know what? I have no desire to buy any more investment properties. I'm not going to do a 1031 exchange. I'm just going to cash out and pay whatever taxes are due. Well, I'm going to be responsible for whatever taxes are due on that particular sale, and all of those deferrals that I did throughout the course of my lifetime up until that point, I'm also going to be subject to having to pay those taxes as well. All right, because with 1031 exchange, it's not a tax avoidance, folks. It's a tax deferral. Okay, deferral meaning that, hey, you may have to pay the taxes someday, but again, if you have heirs and they inherit your property, they're going to get that step up in basis, right? And hopefully, all right, no one ever has to pay the taxes because, again, with the step up in basis, the heirs are not responsible, and all of those previous tax deferrals, basically, they go away and no one ever has to pay them. All right. So, again, it's a really good aspect of 1031 exchange with the step up in basis and that whole estate planning tool for everybody to remember on the line today. All right. Here's an example of the way the step up in basis can work. All right. Let's say I'm the heir, right? Now I inherit the property. Now, for my investment purposes, right, I may look at the property and say, gosh, that's a great property, all right? It has some nice cash flow coming in every month. I'm not going to sell it. I'm going to hold on to it, all right, for my own investment purposes. Now, I hold on to the property. I don't know, let's just say I hold on to it for maybe like 5 years, okay? And then after 5 years, I say, okay, now I'm ready to sell the property, all right? Now, guess what? If I have any gain from when I inherited the property where I got that step up in basis to when I go to sell it 5 years later, I can do my own 1031 exchange, defer my taxes, and basically start the whole thing over again. So again, everybody remember that step up in basis and the benefits when you do a 1031 exchange. All right. Now, what are current tax rates? So typically when you sell real property, right, if you have any gain in the property, right, you're going to be subject to capital gains taxes. Now, capital gains taxes right now are either 15% or 20%, right? The 15% historically was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you were at the 15% capital gains tax rate. Now, the 20% capital gains tax rate historically was applied if you were single and you had income of greater than $400,000 a year, or if you were married and you had income of greater than $450,000 a year. That's where you were at the 20% capital gains tax rates. Now, the reason I say historic, because the income levels have risen just a bit in the last tax reform bill that was passed a few years ago. But still, any way you look at it, you're still going to be looking at either 15 or 20% capital gains taxes. Now, on top of that, you also are going to be subject to what they refer to as depreciation recapture tax, right? That's an additional 25% tax. Now, how does that work, right? Well, the depreciation recapture tax works like this. any depreciation that you've claimed for the lifetime that you've owned the property, all right, when you go to sell the property, they're going to hit you with a 25% tax just on the depreciation alone. All right. Now, on top of that, you also could possibly be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, what is that all about, right? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act, right? So when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing up on the slide? All right, I'm not listing anything to do with state income taxes. Now, most everybody on the slide today is located here in Florida, right? So in Florida, we don't have state income taxes, so we don't even need to worry about that, right? But if we live in a state, okay, or if we're selling property in a state that has state income taxes, we would also be subject to having to pay state income taxes. Now, when you do a 1031 exchange, you can also avoid having to pay those state income taxes. Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right, I'll give you guys a couple of examples. We did an exchange for a gentleman. Now, he was a Florida resident, okay? He owned property in California, an investment property in California, all right? Now, California has state income taxes, all right? I think their state income taxes can be as high as like 11 or 12%. It's kind of like a tiered level. So even though he was a Florida resident, but he was selling property in California, guess what? California still wanted those state income taxes. So the benefit for him, or the good news for him, is that, hey, he was doing a 1031 exchange. So you can actually get out of having to pay those state of California state income taxes. Now, what they made him do was he had to complete the state of California form. He had to submit it to the state, and that's how he got out of having to pay those state income taxes. Now, it's my understanding that he's got to submit that form every year thereafter. The year he doesn't submit the form, they come after him for the taxes. All right. Now, we did another exchange for a lady. She was another Florida resident. I think she was selling property in Maryland. Now, Maryland has state income taxes. Now, what they made her do was she had to complete this state of Maryland form. We actually even had to sign off on it, and I think she had to submit it to the state of Maryland. I think it was like 21 days prior to her closing. In order for her to get out of having to pay those state of Maryland income taxes. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order for you to get out of having to pay those state income taxes. All right. Now, y'all think about this for a minute. Because we're located here in Florida, right? Florida realtors, right? Now, sometimes, because we have so many people that move here, that retire here, right? You, as a realtor, you may not even be involved with the listing side of it, right? You may just be helping the client find some replacement property, an investor, right? Find some replacement investment property. Now, if you know that they live in a state that has state income taxes and they're selling an investment property and they're not talking about doing 1031 exchange, right? Well, that's a perfect opportunity for you to bring it up. Even if if they don't live in a state that has state income taxes, it's a perfect opportunity to bring it up. But those clients that are located in states that have state income taxes, 1031 exchange is even more beneficial to them, right? Because why? Because hey, they're gonna save on the federal taxes like we have on the screens showing up in the screen, the slide, right? But they're also going to benefit from saving. They're going to save on having to pay those state income taxes. Maybe it's a state like New York. It's my understanding New York has state income taxes. They have city taxes. They have county taxes. Okay, again, it just makes them that it's more beneficial for a client that lives in a state that's selling property, or even if they're a Florida resident, they're selling property in the state that has state income taxes. If you're the one that can bring it to their attention, right, doing a 1031 exchange, well, that's just going to give them that much more buying power, right? If they don't have to cut that check to the federal and possibly even cut that check for the state, it's going to give them that much more opportunity to go out there and buy a better property, right? And now if they can buy a better property, a higher dollar property, what does that do for you as a realtor, for your commissions? hopefully you just increase your commissions, right? All by recommending a 1031 exchange to them, all right? Now, how do you actually calculate what the taxes are? Now, this is actually done by a CPA, typically, but I'm just going to walk you all through a really quick example just to kind of give you an idea of what of how they calculate it, what potential taxes could be. All right. Now, in our example, okay, originally we purchased our property for $500,000. Now, over the lifetime that we owned the property, all right, we added back in $25,000 worth of capital improvements. Now, we took some depreciation, okay, for the lifetime that we owned the property, we took $100,000 worth of depreciation. Okay, and now we're going to sell the property for $1 million, right? So in order to calculate what the taxes are, the first thing you need to be able to do is you have to be able to calculate what they refer to as adjusted basis, right? And the way you do that is you take your original purchase price of $500,000, all right? You add back in the capital improvements of $25,000, and then you deduct out the depreciation of $100,000, okay? And that's going to give you an adjusted basis of $425,000. Now, how much are we going to sell it for? We're going to sell it for $1 million. So we take that $1 million sales price, deduct out the adjusted basis of $425,000, and that would actually give us a gain of $575,000. Now, out of that number, how much of that was depreciation? $100,000. Well, we're going to take that out of that number, all right, because the depreciation recapture tax, that 25% tax that I mentioned, all right, that's actually calculated at a separate line item, all right? So we'll take the $100,000 out, we'll multiply that times the 25% depreciation recapture tax, and that would give us a tax of $25,000, right? Now, how much is left over? Well, we still have $475,000 left, all right? Let's just say we're at the highest capital gains tax rate of 20%. So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that would give us a tax of $95,000. Now, let's also say we would be subject to the Medicare tax of 3.8%. So we'll take that $475,000, multiply it times the Medicare tax of 3.8%, and that would give us a tax of $18,050. So when we sell this property, we would be looking at a tax bill of $138,050. Okay, again, when you do a 1031 exchange, you can defer having to pay any of these taxes. All right, now, what am I not listing up on the slide, guys? Anything to do with state income taxes, right? So again, if you live in a state or you're selling property in a state that has state income taxes, well, you have to actually calculate that number as well, right? So again, realtors, think about it, right? If that's your client, right, and they're looking at having to cut a check for $138,050, all right, and then whatever's left over, right? Well, that's what they're going to use to go out and find a replacement property, all right? If you're the one that brings it to their attention, okay, do a 1031 exchange. Avoid having to cut that check for $138,050. Now let's go out and find you something even better, right? That's win-win all around, right? The client's going to win. Why? Hey, they save on the taxes, and now it just gives them that much more buying power to go out there and buy a better property. Hopefully it's a higher dollar property, and hopefully it's going to be a higher income producing properties, right? And you win because why? Hey, you look like a rock star to the client, right? And hopefully you just increased your commissions because now if they can buy that higher dollar property, right, you just increase your commissions all by recommending a 1031 exchange. All right, so some things to think about for everybody on the line today, right? Now, let's talk about some of the tax advantages when you sell real property. All right, so again, a 1031 exchange, all right? You can sell any type of real property that you're using in trade or business or you hold for investment. You can replace it with any other type of real property that you're using in trade or business or you hold for investment. And it's a tax deferral, right? It's not a tax avoidance. We've already talked about that, right? Tax deferral meaning that, hey, you may have to pay the taxes someday, but what happens if you have heirs and they inherit your property? They're going to get that step up in basis, right? And hopefully, no one ever has to pay the taxes. Now, what about your primary residence? Can you do a 1031 exchange on your primary? And the answer is no. Okay, for your primary, You may qualify for what they refer to as a Section 121. All right, and the guidelines for the 121 are you had to have lived in the property as your primary. Um, 2 out of the last 5 years, okay, any 2 out of the last 5 years. And when you sell your primary, all right, if you have any gain in the property and you're single, all right, the first 250,000 of any gain is tax exempt. And if you're married, the first 500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it, all right? It's not like a tax deferral with a 1031 exchange where you may have to pay it someday. With the 121, it's basically you're one and done, all right? You never have to worry about it again. It's a tax exemption. All right. Now, you don't need anybody like me to help you with the 121. All right. That's just something that you claim on your tax return in the year that you file your primary residence. All right. Here's an example of the way the 121 can work. Let's say we go out and in 2010, we buy our primary residence. All right. Now we buy it for $100,000. Okay. Now we're going to live in it as our primary for 5+ years. All right. And then in 2016, we're going to sell it for $1 million. Now I know that's a pretty good deal, right? You're selling it for $1 million. You bought it for $100,000. All right. I don't know if there's any deals like that anywhere here in the Tampa area where I live. I don't know if there's any deals like that anywhere here in Florida. Maybe this is property in New York or I don't know, California. All right. But for our example, we're just going to keep the numbers really simple. All right. All right. So we're selling it for $1 million. Right. And we bought it for $100,000. So our gain's $900,000. Now I know that's not how you calculate it, right? You have to figure out adjusted basis and everything we talked about just in the prior slide. But for our example, let's just keep it simple, right? So we have a $900,000 gain. Now it qualifies for 121, and let's say we're married when we sell the property in 2016. All right, so the first 500,000 of that $900,000 gain, okay, we're going to claim the 121, and that portion of the gain is going to be tax exempt. All right. Now, what's the problem? Well, the problem is we still have another $400,000 worth of gain that we're going to have to pay when we sell the property in 2016. Well, that's going to equate to about $130,000 in taxes when we sell the property, right? Now, what if we could actually do this? What if in 2016 we could take that property and we could convert it over to a rental property, an investment property, right? Let's say we rent it out for 2 years. Okay. Now in 2018, we decide, okay, we're going to sell it in 2018. Now, we'll keep the numbers the same. We're going to still sell it for $1 million. All right. We're still married in 2018, but now that we're selling it in 2018, it's an investment property. Guess what? It now qualifies for 1031 tax-deferred exchange. All right, we can actually do a combination of a 121 and a 1031. All right, the guidelines for that are, again, you have to have owned it for at least 5 years, and you had to have lived in it as your primary any 2 out of the last 5 years. All right, so what we're going to do is when we sell it in 2018, we're going to claim the 121. Okay, on the first 500,000 of gain. All right, and that portion is going to be tax exempt. Now that additional 400,000 of gain, dollars worth of gain that we were paying taxes on in 2016, now in 2018, we're going to claim a 1031 tax deferred exchange on that portion of the gain, and we're going to defer those taxes. So when we sell the property in 2018, we pay no tax. All right, pretty neat, right? Pretty neat way to do it, right? Now, what if we wanted to do this? What if we wanted to go out, we wanted to buy, let's say, a fourplex, all right? We wanted to live in one of the units as our primary, but those other 3 units, hey, we're going to rent those units out. That's going to be the investment portion of it, all right? Same thing. When you go to sell it, did you own it for 5 years? Live in it for any 2 out of those 5 years as your primary. If you did, you can do the combination of the 121 and the 1031. So 1/4 of the gain, you claim the 121, and that portion is going to be the tax exempt. And then the other remaining units, 3/4 of the gain, you claim a 1031 on that portion of the gain, and you pay no tax. All right, you could even do this for, let's say you want to buy a duplex, a double. All right, you want to live in half as your primary, the other half you want to rent that out. Same thing. When you go to sell it, did you own it for at least 5 years? Live in it any two out of the last 5 years? If you did, half of it you can claim the 121, and the other half you claim the 1031 tax deferred exchange. All right. Now, I get this question all the time. All right. People will ask me, they say, well, Jeff, how long do I need to hold on to a property for it to be considered an investment property? And, the honest answer is I don't know, because there's nowhere in the code that states how long you need to own a property for it to be considered an investment property. All right. It just states that you need to use the property in your trade or business, or you have to hold it as an investment. All right. Now, if you ask some CPAs, they'll tell you, well, a good rule of thumb is to hold on to a property for at least a year, for 12 months, right? And if you just think about the logic behind that for a minute, right? Let's say I buy an investment property today, all right? And I'm going to hold on to it as an investment for 12 months, for a year, right? It's going to be a rental property. Now, I'm going to claim that property as an investment property on my 2021 taxes, and I'm also going to claim it as an investment property on my 2022 taxes, right? Any income that's coming in from from rent, any expenses that are going out, all right? I'm actually going to be reporting that as an investment property over 2 tax filing years, right? Is that a good rule of thumb? Well, the answer is maybe, okay? Because some other CPAs, they'll tell you, well, really a good rule of thumb is to really hold on to a property for at least 2 years, all right? Or 24 months, all right? And one of the reasonings behind that, all right, we're going to talk about that, talk about it in the very next slide. But back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in those guidelines for vacation homes, the IRS stated for that vacation home to be considered an investment property, you must own that property for a minimum of 2 years or 24 months. All right, so some CPAs pick up on that and they say, well, for vacation homes, the IRS is giving us guidelines for that vacation home to be considered an investment property. You must own it for 2 years or 24 months. Therefore, any type of investment property, for it to be considered an investment, you really need to hold on to it for 2 years or 24 months. But the reality of the whole thing is it's not so much about how long you own the property, okay? It's more so about your intent, all right? And your intent could be something like this. Did you advertise the property for rent, okay? Did you advertise it for fair market value rent? All right, if fair market value rent is, let's say, $1,500 a month, and you're advertising it for $5,000 a month, well, you know what? The IRS is probably going to have an issue with that. All right, if you ever get audited and the IRS comes in and says, prove to us you held that property for investment, you're going to have to be able to back it up. All right. I list one particular court case on the slide. It's referred to as Resnick versus the commissioner. Now, in that particular court case, the circumstances was you had a husband and wife. Okay, they owned a single-family residential home. That was their primary home. All right, they also owned another single-family residential home that was an investment property, a rental property. So what they did was they sell the investment property, the rental property, in the 1031 exchange. All right. Now the replacement property that they purchase is another single-family residential home. That was going to be the new investment property. All right. Now, during this 6-month period after they did their exchange, okay, they actually ran a classified ad in the town newspaper that they lived in, advertising the property for rent at fair market value. All right, now they even showed it to 2 potential renters during that 6-month period, but for whatever reason, they could never get the property rented out. Now, what else happened during that 6-month period is one of them loses their job. Okay, well, they had a mortgage on their primary home. They also had a mortgage on the new investment property, but what? It wasn't rented out, right? So after 8 months of ownership, they actually sold their primary home and they moved into the investment property. Okay, in that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Well, their circumstances changed, right? And they were forced to do something. So again, it's not so much about how long you own a property. It's more so about your intent. And again, if you get audited, you're going to have to be able to back it up. All right? So remember, investment intent. All right, vacation homes. Now, I always like to talk about vacation homes whenever I do any type of presentation in Florida. Because why? Because, hey, we live in Florida, right? It's like, everybody wants a vacation home or everybody has a vacation home. So, how does that vacation home qualify as an investment property? All right. So, this is actually referred to as Revenue Procedure 2008-16. All right. In the first guideline, I've already mentioned to you guys, all right, you must own the property for a minimum of 2 years or 24 months. All right. Now, for every 12-month period of ownership, okay, you must rent the property out for a minimum of 14 days at fair market value. Okay, now you can use it for some personal use. Okay, for every 12-month period of ownership, you can actually use the property for 14 days personal use or 10% of the total time that it was rented during that 12-month period. So let's just say during that 12-month period, you actually rented the property out for 200 days, right? Now, 10% of 200 would be what? Would be 20, right? So you could use the property for personal use for 20 days during that 12-month period instead of the 14. Okay, now if that property meets those guidelines, it qualifies as an investment property. Okay, now if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified. All right, in that case, I would recommend to the client, I'd say, look, talk to your CPA. Okay, and if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, use it in a 1031 exchange. All right, we're always going to recommend to people talk to your CPA because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I would even ever want to know, right? And if the CPA, hey, comes back and says, yeah, I feel like we can justify that property as being an investment property, then you know what? Hey, we move forward with it in a 1031 exchange, right? So remember, vacation homes. Now, I talked to y'all in the very beginning, a lot of the topics or some of the topics that we're covering today, I have in PDF form, just single pages. I have one just on vacation homes. I'm going to send that out again to everybody in an email along with some other of the topics that we're going to be talking about today. All right. Now, who can do a 1031 exchange? All right. So with exchanging, okay, very important. Whoever the taxpayer is in the sale of the relinquished property, okay, that's the property being sold in a 1031 exchange, needs to be the same taxpayer in the purchase of any replacement property or properties. All right, now, individuals can do 1031 exchanges. Husband and wives can do 1031 exchanges. Spouses can do 1031 exchanges. Now, sometimes we see this with spouses. Let's say one of the parties owned an investment property prior to being married. All right, let's just say it's the wife, right? She owned an investment property, a rental property, right? Prior to being married. Now, she gets married, and then during the course of the marriage, she decides she wants to sell that investment property. She wants to sell the rental property, and she wants to do a 1031 exchange because she wants to defer the taxes. Now, the replacement property that she wants to buy, all right, in order to buy that replacement property, she needs to get a loan, a mortgage, right? And in order to qualify for the loan, she needs to bring her husband in because she needs his income to help her qualify for the loan, right? So how can you do that when you do a 1031 exchange? Well, one possible solution would be to take title in the replacement property as what they refer to as tenants in common. Now, hopefully everybody on the line knows what tenants in common ownership is, but if you don't, it's pretty simple. You can own a certain percentage of a property. So in the scenario of the wife, the spouse, needing to bring the husband in, what you could possibly do is you could bring the wife in and make her like a 99% tenant in common owner, and then you could bring the husband in and make him a 1% tenant in common owner. Now, obviously, you'd have to get the lender's approval to do any of this, all right? If they would go for that ownership structure with the tenants in common, then, hey, you could get the loan and move forward with purchasing that replacement property, all right? And that brings me to the next bullet. Tenant in common owners, right? Tenant in common owners can do 1031 exchanges as well. All right, I'll give you guys an example. Let's say I want to go out and I want to buy an investment property, but I want to bring somebody else in with me to help me purchase it. All right. And we're going to buy the property. We're going to take title to the property as tenants and common owners. All right. Where I'm going to own 50% of it and he's going to own 50% of it. Right. So we buy this property, an investment property, 50-50, tenant and common owners. All right. Now we hold on to it for a period of years. And then at some point we decide we want to sell it. Now for me, I'd like to take my 50% tenant in common ownership and I'd like to do a 1031 exchange because I want to defer my taxes and I'd like to go out and buy a replacement property. Now, my other tenant in common owner, he says, you know what? I have no desire to buy any more replacement property, any more investment properties. I'm fine with just cashing out and paying whatever taxes are due. Well, he has the option to do that. All right, and I have the option to do what I want to do. Again, if I want to do a 1031 exchange because I want to defer my taxes and I want to buy a replacement property, an investment property, I can do that. Now, he could do his own 1031 exchange if he wanted to defer his taxes, and he could go out and he could buy his own replacement investment property. Okay, so tenant and common owners can do 1031 exchanges. Right, any type of legal entity that owns real property can do a 1031 exchange. Okay, corporations, trusts, partnerships, LLCs. Okay, sometimes we see this with LLCs. Let's say I have an LLC, and for tax purposes, it's referred to as a disregarded entity. Now, disregarded meaning that I don't file a separate tax return for that LLC. Okay, anything to do with that LLC, I just put that on my personal taxes. All right, that's referred to as a disregarded entity. Because for me as an individual and my disregarded LLC are considered one and the same. Because why? Because it's all being filed under one tax return. All right, it's common that you see that disregarded LLCs with maybe a single member LLC. All right, some of y'all on the line for your real estate business. Right, you might have your own LLC just for your real estate business. Well, what do you do at the end of the year? Well, you don't file a separate tax return for that LLC, right? Anything to do with that LLC, you just put on your personal taxes. Well, that's referred to again as a disregarded entity because you as an individual and your LLC are considered one and the same. Right, so with 1031 exchange, okay. Let's say you own a property as an individual. You own an investment property as an individual. All right, you do a 1031 exchange. Now, the replacement property, you have the option. Okay, you can purchase the replacement property in your name as an individual, or you could even buy the replacement property in the name of your disregarded LLC. Because why? Because for tax purposes, you're one and the same. All right, it works just the opposite way too. You could sell a property in the name of your disregarded LLC, and you could take ownership in the replacement property in your name as an individual or your disregarded entity, your disregarded LLC. Because again, for tax purposes, they're all one and the same. All right, now sometimes we even see this with LLCs. Let's say somebody goes out and they want to buy 1234 Main Street. Okay, it's going to be an investment property. Now, what do? They go out and create 1234 Main Street LLC. All right, that's going to be a disregarded entity. Meaning what? They're not going to file a separate tax return for 1234 Main Street LLC. Anything to do with that LLC, they're just going to put in their personal taxes. Right? Well, they can do that. All right. Now, they hold on to that 1234 Main Street. All right, in the name of 1234 Main Street LLC. It's an investment property. Hold on to it for a period of years. And then at some point they say, okay, we're going to sell it. And we're going to do a 1031 exchange, right, to defer the taxes. Now, the replacement property that they go out and buy, well, they want to go out and buy 5678 Central Avenue. But you know what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? Well, in that case, they go out and create 5678 Central Avenue LLC. That's also going to be a disregarded entity, meaning that what? They're not going to file a separate tax return for that LLC either. They're just going to put it in their personal taxes. Well, they can do that because why? Because all of those disregarded entities are considered one and the same with each other, and they're also considered one and the same with the individual. Because why? Because it's all being reported under one tax return. Okay, so remember with 1031 exchange, whoever the taxpayer is in the sale of the relinquished property needs to be the same taxpayer in the purchase of any replacement property or properties. All right. If it's what's referred to as a regarded entity, all right, maybe it's a corporation, a multi-member partnership, a multi-member LLC. Okay. If that entity files a separate tax return, okay, and then issues like K1s to all the partners, the members, that's what's referred to as a regarded entity. All right, if that LLC, corporation, partnership, whatever it may be, is the owner of the property, the tax owner, all right, and does it and it does a 1031 exchange on the sale, that same entity, that regarded entity, needs to be the purchaser in any replacement property or properties. All right, if all of us on the line today, if we're all involved in a partnership, all right, let's say we own a building, okay, and we sell that building in the 1031 exchange. Well, the replacement property, we'd have to purchase it in the name of our partnership, right? We could never try to go out and try to buy replacement property in our name as individuals, because why? Because, hey, we don't actually own it. Our partnership does, all right? So keep that in mind. Whoever the taxpayer is in the sale needs to be the same taxpayer in the purchase of your replacement property, all right? Now, sometimes we see this with partnerships, okay? Sometimes when a partnership sells real property, investment property, well, the individual partners may have different goals, right? You may have one partner that says, okay, well, I think our partnership, I think we should do a 1031 exchange because I think the partnership should defer its taxes, and I think the partnership should go out and buy some replacement property. But you might have another partner that says, you know what? I don't think our partnership should do a 1031 exchange. I don't think we should buy any more investment properties. Well, how can you do that, right? With 1031 exchange. Well, here's two solutions, right? Now these are actual terms that we use in the industry. Okay, the first one's referred to as a drop and swap. Okay, now the drop and swap can work something like this. Let's say we have a multi-member partnership. Let's just keep it simple. Let's say we have 3 partners in the partnership. Okay, the partnership owns real property, an investment property. Okay, now the way the drop portion of it works is the actual partnership itself will be dissolved. Okay, and then what they do, they dissolve the partnership and they change the ownership structure in that real property, the investment property, to tenants in common. And what do we say? We had 3 partners, right? So the former 3 partners become tenant in common owners of the real property. So basically, they're each 1/3 owner of the real property as a tenant in common. Now, as tenant in common owners, they're going to have to hold on to that property probably for a year or two. Because why? Because they need to show that their intent, okay, as tenant in common owners, is to hold the property as an investment. Right now, after the year or two passes, then they can do the swap. Then they can sell the real property, okay, and then each partner or former partner, each tenant in common owner, can do what they want. One wants to do a 1031 exchange and defer their taxes and buy a replacement investment property, they can do that. Hey, another tenant in common owner, he says, well, I don't want to do a 1031 exchange, I don't want to buy replacement property, he can cash out and pay whatever taxes are due. All right, now, the opposite of a drop and swap is referred to as a swap and drop. Okay, they can work something like this. Again, we have that 3-member partnership, right? Owns the real property. So the swap portion works like this. The actual partnership itself will do a 1031 exchange and defer the partnership's taxes, right? But the replacement property that the partnership goes and buys, instead of buying 1 replacement property, the partnership will go out and buy 3 replacement properties. Now, why 3? Because, hey, we have 3 partners, right? And the thinking is each partner is going to have a say in which property they gets purchased, right? Now, once the partnership buys those 3 replacement properties, the partnership itself is going to have to hold on to those properties probably for a year or two. Because why? Because the partnership needs to show that it's holding those properties with the intent for investment. All right. Now, after the year or two passes, then they can do the drop. Then they can dissolve the partnership, and then each partner will get one of those properties. Okay. With either one of these examples, okay, it's going to take some time, right, It's going to take a year or two before everything is over and done with, right? Sometimes, unfortunately, the whole reason partnerships want to sell because the partners can't stand each other, right? So with either one of these scenarios to work, the partners are going to have some type of agreement that they're willing to deal with each other for the next year or two, right? If they can't come to some type of agreement, probably neither one of these scenarios are going to work, all right? So drop and swap and a swap and drop, right? Now, I get this question sometimes. People will ask me, they say, well, can a foreign seller do a 1031 exchange? And yes, a foreign seller can do a 1031 exchange, but a foreign seller is actually going to be subject to an additional tax referred to as the FIRPTA tax, all right? Now, that's an additional 15% tax. It's based off of the gross sales price. Now, the great news is when the foreign seller is doing a 1031 exchange, they can also get out of having to pay the FIRPTA tax. Right? There's an actual exemption certificate that they can apply for, and the IRS will issue an exemption certificate just for that transaction for them to get out of having to pay the FIRPTA. Now, it doesn't happen overnight. All right, and remember, everybody, this is the IRS. They move at their own pace. Okay, it can take anywhere from 6 to 8 weeks to get this exemption certificate issued. All right, you have to have a tax ID number. If you don't, you have to apply for one. Okay, you have to complete the form requesting the exemption certificate. Again, all that kind of stuff takes some time. All right, but again, it can be done. All right, I have a great PDF flyer that I'm going to send out to everybody that talks about all these steps. Okay, some of the other things that can affect FIRPTA, where they can get out of it. If the sales price is less than $300,000, okay, and the buyer is actually going to live in the property as their primary residence, their primary home, then there's no FIRPTA withholding. Now, if the sales price is anywhere from $300,000 up to $1 million, and the buyer is going to live in it as their primary home, then there's only a 10% FIRPTA withholding. Now, if the sales price is greater than $1 million, it doesn't matter either way if the buyer is going to live in it as their primary home or not. It's still the 15%. You know, typically in a 1031 exchange property, investment property, the typical buyer of a 1031 exchange property is also an investor. They never have any intent on living in it as their primary. All right, but that's some of the ways you can get out of foreign of the FIRPTA withholding. What are foreign sellers, foreign individuals, foreign entities? Okay, it's my understanding that even if you have a U.S. based company, I had a guy call me a few years ago. He was a U.S. based company. He was a U.S. citizen, but one of his partners was actually a foreigner. Well, we're going to be subject to that FIRPTA withholding. But again, the great news is you can apply for the exemption certificate if you're doing a 1031 exchange. Okay. Now, related parties in 1031 exchange. You know, if you sell to a related party and you're doing a 1031 exchange, or if you're purchasing from a related party in a 1031 exchange, you just need to be really, really careful. All right. Related parties, that's like your spouse, your kids, your parents, your grandparents. If you own more than 50% in a company, in an entity, that's considered a related party. All right. I list part of a form on the slide. That's part of IRS Form 8824. Now, IRS Form 8824 is the actual form that you complete or your CPA completes, and you submit that with your tax return. That's the way you report your 1031 exchange to the IRS on your tax return. It's IRS Form 8824. On that form, okay, they specifically ask, did you buy from a related party or did you sell to a related party? Okay, they're looking for that. All right, for lack of a better word, the IRS, they don't want any funny business going on with 1031 exchange. Right, they're looking for an arm's length transaction. All right, you can only buy from a related party if that party is also doing a 1031 exchange. Okay, you can only sell to a related party if that party holds onto the property for at least 2 years. Okay, so again, you just need to be really, really careful if you're doing anything with a related party in regards to 1031 exchange, right? You have to dot every I and cross every T, all right? If they're looking for it on that form, it's a red flag, all right? It could possibly trigger some type of audit, all right? Now, why is exchanging beneficial to realtors? Now, this is probably the main reason you attended today's presentation, right? To say, hey, what's in it for me as a realtor, right? Well, for one thing, with 1031 exchange, okay, there's always going to be two transactions, right? There's always going to be what we refer to as the relinquished property, the property being sold in a 1031 exchange. And there's always going to be a replacement property. That's the property that's being purchased in a 1031 exchange. So two transactions, what does that equate to for you guys as realtors? Two commissions, right? Now, one of the rules to exchanging, okay, the replacement property that gets purchased in a 1031 exchange, all right, that purchase price must be equal to or greater than whatever the sales price was on the property that was sold, all right, the relinquished property. So what does that mean for you guys as realtors? What that means is the commission that you're going to make on the replacement property, well, that's going to be as good, if not better, than what it was on the property that was sold, the relinquished property, just because of that rule. Okay, now the 1031 tax savings benefit. Now we've kind of already talked about that. Y'all think back to the slide where we talked about when we calculated the taxes, right? That client sitting there thinking, hey, they're going to have to cut a check for $138,050, right? And then whatever's left over, hey, now let's go out and find me some replacement property. Again, if you're the one that brings it to their attention, you show to them, hey, do a 1031 exchange, avoid all those taxes, right? It's going to do what for the client? Save on the taxes, but hopefully now they can go out and buy a higher dollar property, right? And what's that going to do for you as a realtor? Well, hopefully you increase your commissions, right? I'll be recommending a 1031 exchange, all right? Now, sometimes we even see this, okay? Sometimes the property that's being purchased in a 1031 exchange, okay, that particular seller is also an investor. Now, they may not know anything about 1031 exchange, right? If you have the opportunity to talk to them, present to them about doing a 1031 exchange, hey, who knows? Maybe you can pick up another transaction. Maybe you can help them find some replacement property, all right? Now, y'all think about this for a minute. Any property out there that is non-owner occupied is a potential 1031 exchange candidate. Why? Because if they don't live in the property, they might be holding it as an investment. Right now, there's databases that you guys as realtors can tap into to get those kind of leads, right? There's one that I know of. It's actually referred to as List Source, okay? It's actually a product of CoreLogic. Now, y'all probably have heard of CoreLogic, all right? They're a huge data company, all right? So they have a product called List Source. Now, within List Source, you can do searches by zip code, geographical area, subdivision, and so on, all right? And the results that it'll give you the mailing address of the property, and it will also give you the property address, okay? Well, if that mailing address and the property address are two different addresses, you know they don't live in the property, all right? They may be holding it as an investment. Or you could actually target the mailing address to the actual owner of the property. Because I tell you what, we see this all the time. Somebody will own an investment property. Let's say they own a rental property, right? And they've owned that thing for years, right? And they know, boy, if they ever sell it, they're going to be looking at a huge gain, and they're going to have to cut a check to the government. And you know what? They just don't want to cut that check. So what do? They just hold on to the property, not knowing they have any other options out there. Again, if you're the one that targets that mailing address, you target the owner of the property, and you say, hey, you do have an option. You can do a 1031 exchange, and you can defer all those taxes. Avoid having to cut that check. Now let's go out and find you something even better. Man, who knows? Maybe they can go from owning one investment property, one rental property, do a 1031 exchange. They might even be able to go out and buy two replacement rental properties, two investment properties, okay? Where now, hey, they have two tenants, two different properties, two income streams coming in, and they're not so reliant on just that one income every month. Because, hey, if they lose one of the tenants, they still have some income coming in. Hopefully, they're making more money every month. They're bringing in more cash flow, more income coming in. Now, There's other databases that you guys can tap into within your MLS system. Okay, people tell me, realtors tell me that you'll have a product called iMaps. You also have another product called Remind. All right. Also, depending on the county, okay, the property appraisers offices. Certain property appraisers offices will let you do searches by absentee owners. Okay. People tell me in iMaps and Remind, it'll let you do searches by absentee owners. Absentee owners, they don't live in the properties, right? They might be holding them as an investment. Okay, if any of y'all on the line today, if you work any of the areas of like Central Florida in the Orlando markets, right, around the theme parks, Disney, Universal, SeaWorld, or you work any of the beach communities, West Coast, East Coast, anywhere throughout the Eastern United States, if you're located in another state, all those beach type of communities, those how many absentee owners are located in those types of areas of the country, of our state in Florida? They're everywhere, right? They might be holding those properties as investment, right? They might be potential 1031 exchange candidates, right? If you thought, boy, I really love to be able to start working with investors, but how do I get my foot in the door with them? Well, maybe 1031 exchange becomes a tool for you to approach those investors to get your foot in the door with them. All right. If you're looking for ways to increase your business, how you're going to stand out from all the other realtors, well, maybe this becomes a niche for you. Okay. So again, some things to think about for everybody on the line today, right? Now, the 1031 exchange guidelines. All right. We're going to talk about the property qualifications. We're going to talk about the tax deferral requirements. All right. There's some timelines everybody needs to be aware of. All right. And there's also some identification rules that everyone needs to be aware of. Okay, now, the property qualifications, again, what type of property can you do a 1031 exchange on? Any type of real property that you use in your trade or business, or you hold for investment, and you can do what? You can exchange it for any other type of like kind property, which is what? Any type of real property that you use in your trade or business or that you hold for investment. And where can those properties be located? Anywhere in the United States, including Guam or the U.S. Virgin Islands. Remember, property in Puerto Rico is not included in that number. Okay? Now, what types of properties are excluded from 1031 exchange? Well, your primary residence, right? We've already talked about that. What do you do for your primary? Well, you may qualify for that Section 121, right? Now, what about property held for sale? Well, property held for sale is also excluded from 1031 exchange. Now, I'll give you an example of what that could potentially be. Here in Florida, we have a lot of these like national home builders, right? We have like Pulte Homes, Lennar Homes, KB Homes. Let's say I'm Pulte, right? Now, Pulte is one of the largest single-family residential home builders in the entire country, right? They build newly constructed properties in multiple states, right? Well, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, they can't do 1031 exchanges on those types of properties, right? Because that's property held for sale. Property held for sale is excluded from 1031 exchange. Now, dealer property is also excluded from 1031 exchange. Now, what exactly is dealer property, right? Well, dealer property might be somebody that we consider a flipper, right? Let's say they buy a property. I don't know, 2 or 3 months goes by. They fix the property up during that period, and then what do? They turn around and sell it, right? Well, they can't do 1031 exchanges on those types of properties, right? Because that's like their inventory. That's the business that they're in, right? They fix properties up, and then when they're completed, what do they do with them? They turn around and sell them as well. Well, you can't do 1031 exchanges on those types of properties. Now, here's a possible solution for a flipper if they wanted to go this route. Let's say they buy a property, right? 2 or 3 months goes by. They fix it up. And instead of turning around and selling it when it's completed, they come to you, all right? You're their realtor, and they say, hey, could you put this property in the MLS system showing it for rent? Let's make sure we put it in there for fair market value rent as well. That's a little bit different, right? Because now all of a sudden they're showing that their intent, right, is to hold the property as an investment and not for sale. All right. Hey, who knows? Maybe they even show it to a potential renter. They run some type of credit report on the potential renter. I don't know. They don't have such great credit, and they decide not even to rent the property to that potential renter. Okay. If that flipper gets audited, and the IRS comes in and says, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up. Okay. In the example I just gave y'all, hey, there's a good chance they could back it up, right? They could say, look, here's an email that I sent to my realtor requesting them to put it into the MLS system, showing it for rent at fair market value. Hey, here's the MLS listing showing it for fair market value rent. Here's the day I showed it to that potential renter. Here's the day here's the credit check, the credit report that I ran at a potential renter. All of that type of stuff is going to be their backup, right? It's going to be their ammunition, their trail of breadcrumbs, right, to prove that they held that property for investment and not for sale, right? If they just strictly just fix the property up, however long it takes them, okay, and then they turn around and sell the property, you can't do a 1031 exchange on that type of property, all right? So dealer property is excluded from 1031 exchange. Now, the next bullet, foreign property is also excluded from 1031 exchange. Now, this might be pretty obvious, but let's say I couldn't sell a property located here in Florida, an investment property, in a 1031 exchange, and then try to buy a replacement property somewhere in Canada or Mexico or somewhere in Europe. It has to be what? Property located in the United States, including Guam or the U.S. Virgin Islands, right? So foreign property is excluded from 1031 exchange, all right? Now, guideline number 2, the tax deferral requirements. So in order to get a full deferral, to defer your taxes 100%, right, rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. Now, what exactly are net proceeds? Net proceeds, that's the cash, right? That's the cash that normally you would get out of the closing. Okay, now we're the qualified intermediary, the QI. Okay, we're going to hold those proceeds on behalf of the seller, the exchanger. Okay, because the rule is they can never actually have receipt of those funds. Okay, if they do, they lose their ability to do a 1031 exchange. Okay, so they can't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange, because at that point they have receipt of the funds, actual receipt. They've lost their ability to do a 1031 exchange, right? They couldn't even close today, all right, and walk out the door from the attorney's office, escrow company, title company, all right, get in the parking lot and call me from the parking lot and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, okay, because they actually, they may have what's referred to as constructive receipt, okay? That attorney, escrow company, title company, they may be waiting to wire the funds to the client, the seller, right? That's considered constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange, okay? So we must get involved prior to the closing, basically prior to them walking out the door, okay? And they have to take the entire net proceeds that we're holding on their behalf, okay? And what do they need to do with it? They have to take that entire amount, and they have to use that towards buying replacement property, or it can even be a combination of properties, okay, where the purchase price or the combined purchase prices are either equal to or greater than whatever the sales price was on the property that they sold, right, the relinquished property. That's rule number 1. Now, rule number 2 is you must acquire an equal amount or greater debt. Now, exactly what does that mean, right? Well, if you have a loan that you're paying off, a mortgage, okay, you must obtain a loan of at least that amount or greater in the purchase of any replacement property or properties. Now, that rule can actually have an exception, okay? If you have cash that you can add to the purchase of your replacement property, you can offset having to acquire any debt or any additional debt, okay? Now, obviously, if you have no mortgage that you're paying off, you don't have a loan that you're paying off when you sell your relinquished property, well, you're not required to obtain a loan in the purchase of any replacement property or properties, but you do have the option, okay? You can get a loan to help you purchase your replacement property or property, all right, if you want to or if you need to. All right. Now, how do the numbers work? All right, so in our example, okay, we're going to sell our relinquished property for $1 million. Okay, so we'll take that $1 million sales price. Now we have a loan, okay? We have a loan payoff, all right, the debt of $300,000 that we're going to be paying off. Okay, so we take that $1 million sales price, we deduct out the $300,000 debt, all right, the payoff amount of $300,000. Now, we have some cost of sales associated with the closing. All right, let's say that's $50,000. That's like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees. Okay, let's say that's $50,000. So we'll deduct that out, and that's going to leave us with a net proceeds of $650,000. Okay, again, we're the qualified intermediary. Right, we're going to hold that $650,000 on behalf of the seller, the exchanger. All right, now what are they going to do with that amount? Well, in this example, they're going to take that entire $650,000 and they're going to use that towards purchasing a replacement property for $1.2 million. Okay, so by doing that, they just meet rule number one. Because why? Because they're taking the entire net proceeds, the $650,000, and in this example, they're actually going out and they're buying a replacement property that's greater in value than what they sold, right? Because they sold for $1 million, well, they're buying a property for $1.3 million. Okay, now, they still need another $550,000 to help them purchase that replacement property for $1.2 million. So what do they do in that case? Well, they go out and get a loan for $550,000. By doing that, they just meet rule number two. Because why? Because they had a loan that they paid off. They had debt that they paid off of $300,000, and they actually acquire greater debt, right? The new loan that they obtain is $550,000, right? So in this particular example, they would get a full deferral. They would defer their taxes 100%. Okay, now what if they wanted to do this? What if they said, well, we don't want to get a loan for $550,000? No problem. All right. If they happen to have $550,000 cash that they can add to the purchase of the replacement property, that would have worked for them too. All right. Or if they would have said, well, we don't want to get a loan for $550,000. We do have some cash that we're willing to put towards buying the replacement property, and then the difference will make up in a loan. That would have worked for them too. Okay. Now, what if they wanted to do this? Out of the $650,000, they may say, well, we don't want to use all of that towards buying our replacement property. Okay, we want to take $100,000 out of the proceeds, and we want to put that in our pocket. Okay, and we only want to use $550,000 towards buying the replacement property. Well, they have the option to do that as well. Okay, but the $100,000 that they don't use towards buying the replacement property, they're going to be subject to taxes on that amount. Okay, it's referred to as cash boot. All right, it doesn't mean that they can't do a 1031 exchange. Okay, what it means is instead of them getting a full deferral, okay, they're going to get what's referred to as a partial deferral. Now, partial, why? Because they're going to be paying some taxes on that $100,000 cash boot. Okay. Now, the $100,000 that they hold back, they can do whatever they want with those funds. All right. If they want to pay off bills, maybe they have a child starting college, they want to pay for college. I don't know, they want to go on a great vacation, or who knows, maybe they want to go to Vegas, they want to blow it all gambling, all right? Whatever they want to do with that $100,000, they can do with it. But again, they're going to be subject to taxes on that, all right? Now, we hold back to the example, okay? So we're going to hold the $550,000, all right? And what are they going to do with that $550,000? Well, in the example, they're going to use that entire amount, and they're going to go out and they're actually going to buy a replacement property of only $800,000. So they go down in value, right? They use the entire $550,000 to help them buy the property for $800,000. Now they still need another $250,000. So what do they do in this case? Well, they actually go out and they get a mortgage for $250,000. But by only getting a loan for $250,000, they actually go down in debt by $50,000, right? Because they had a loan that they paid off of $300,000, and they only obtained $250,000, a replacement loan for $250,000. So they went down in debt by $50,000. They're also going to be subject to taxes on that amount. All right, that's referred to as mortgage boot. So there's two types of boot. Okay, there's mortgage boot and there's cash boot. Again, it doesn't mean that you can't do a 1031 exchange. All right, it just means that instead of you getting a full deferral, you're going to get a partial deferral. Again, partial why? Because you're going to be paying some taxes on the boot. Now, typically, the tax that you pay on the boot is going to be significantly less than if you just sell the property outright. Okay, if anybody ever wants to do anything like this, I always tell them, hey, talk to your CPA, all right? Because you really, really need to know your numbers, right? You need to look at it and say, okay, if I don't do a 1031 exchange, okay, if I just sell the property outright, now what does my tax situation look like? Now, if I do a 1031 exchange, okay, but I pay some taxes on the boot, well, what do my taxes look like? Well, typically, again, the tax that you pay on the boot is typically going to be less than if you just sell the property outright and you don't do a 1031 exchange. But if your taxes happen to be greater by paying taxes on the boot, all right, then if you sold the property outright, okay, then don't do a 1031 exchange, okay, because it's not going to be worth your while. You're going to lose money, all right, if you're going to be paying higher taxes on the boot. So again, always, always, always talk to your CPA and get your numbers. Make sure you know what you're looking at before you do anything, all right? Now, there's some timelines everybody needs to be aware of, all right? So for when you sell your relinquished property, okay, you're going to have 180 calendar days to purchase any replacement property or properties, okay? And that's calendar days. That's holidays. That's weekends. Okay, hey, folks, we live in Florida, right? From June 1st to November 30th is what? Hurricane season, right? Hey, if we're getting hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, okay, it does not matter. That clock is always going to be ticking. All right, so it's 180 calendar days to purchase any replacement property or properties. Okay, the first 45 days of the 180 days is what's referred to as the identification period. Okay, and what exactly does that mean, right? What the identification period means is you must identify any potential property or properties that you want to buy. Okay, none of them even have to be under contract. You just have to identify any potential properties. Okay, now that's something else that we're going to assist with. All right, we're going to provide a form to the client, the exchanger. It's called the identification ID letter. Okay, and on that form, there's going to be some blank lines. Okay, and it's going to have to be specific to a property address or addresses. Okay, the client's going to have to fill that out, sign off on it, get it back to us by midnight of the 45th day. Okay, that's how they will formally identify their replacement property. They're going to do it to us, the qualified intermediary. Okay, again, none of them have to even be under contract. But here's the thing. Okay, let's say they go out and they find the perfect replacement property, and let's just say it's day 46. Okay, at that point, it's too late. Okay, so whatever they put on that form by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties. Okay, if they're unable to purchase any of those properties, okay, by day 180, unfortunately, they're going to be paying all their taxes. Okay, if they're purchasing the property on day 181, they're paying all their taxes, right? There is no exceptions after midnight of the 45th day. All right, if one of them burns down to the ground, one of them gets destroyed in a hurricane, one of them gets sold, all right, none of that matters. Whatever they put in that form by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties. Okay, now, why is the 45-day requirement great for you guys as realtors? Because your client needs to make a decision within 45 days after they sell their relinquished property. Okay, you're not going to be spending weeks and months on end showing them property. They have to figure out what they potentially want to buy by midnight of the 45th day. All right, and they have to buy it by day 180. Okay, now there's some rules to actually identifying property. Okay, we refer to them as identification rules. All right, now there's 3 different rules. Now I'm going to read each one of the rules to you. Okay. And if for some reason you don't understand them, don't worry about it because I'm going to walk you through examples of how the numbers work for each one of the rules. And hopefully, once I explain to you how the numbers work, it's all going to click for you. All right. Now, the most popular rule that we see uh, clients enacting, probably I don't know, 90 to 95% of all the exchanges that we do fall into this first rule. All right. It's referred to as the three property rule. All right. And the three property rule states this: you can identify up to three properties without regard to the fair market value of those three properties. All right. So what exactly does that mean? Well, what that means is if you identify three properties or less, okay, the purchase prices of any of those properties can be any dollar amount. Okay. It does not matter as long as it's three properties or less. Okay. Now, if you want to identify more than three properties, well, you can do that. Okay, but it's going to put you into this next rule. Okay, it's referred to as the 200% rule. Right, and what the 200% rule states is you can identify over three properties, but you cannot exceed 200% or two times the combined fair market value of the property being sold. So, what exactly does that mean? Right, well, if you identify more than three properties, okay, the combined purchase prices of all those properties that you've identified, okay, cannot exceed 200% or two times whatever the sales price was on the property that you sold, okay? Now, if you want to exceed the three property rule and you also want to exceed the 200% rule, well, you can do that as well, but you're going to fall into this next rule, okay? It's referred to as the 95% rule. Now, it doesn't really make a lot of sense the way it's written, okay? But remember, everybody, this is the IRS, and sometimes this stuff just doesn't make sense, okay? It's very rare that we even see any clients even enacting this rule, okay? But it does exist, and I want to just make sure everybody realizes it's out there, okay? Because it reads like this. Okay, you can identify over three properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, right? Like I said, it doesn't make a lot of sense. But let me show you all the examples of how the numbers work, especially with this last one, the 95% rule. I think once I show you how the examples work with the numbers, it's going to make sense to you. Okay. Now here's the three property rule again. Three property rule is you can identify three properties, okay, up to three properties without regard to the fair market value. So those purchase prices can be any dollar amount, all right? It does not matter as long as it's three properties or less, okay? So here's an example of how it can work. All right, so we sell for $1 million. Now, we go out and we identify three properties, okay? Since we've identified three properties, okay, we're in the three property rule. All right, let's just say, keep the math simple. Let's say we're going to buy each one of those properties for $1 million each, okay? So we've identified $3 million worth of property, right? Now, we could be buying each one of those properties for, I don't know, $10 million each, all right, for a total of $30 million in identification. Again, it doesn't matter. As long as we identify three properties or less, the purchase prices can be any dollar amount. It does not matter. But what does matter, and I'll say it again, folks, if you identify three properties, boy, you better make sure you're going to be able to purchase at least one of those properties. So, what's the best way to lock up a property? Well, it's to put one of them under contract, right? You're not required to put one of them under contract, but that's the best way for you to ensure that you're going to be able to purchase that property, especially in the market that we're in right now, right? Where properties are just turning over really fast. So in practice, what we see is people will put one property under contract. That's one of the properties they identify. And then, I don't know, maybe they'll identify two other properties, obviously, that are not under contract, all right? They submit that on the form, those properties on the form by midnight of the 45th day, just in case if after midnight of the 45th day, if the property that they do have under contract, if for some reason that whole thing falls apart, if the contract falls apart, well, at least they'd have the opportunity to purchase those two other properties that they would have identified on the form, okay? So again, that's the three property rule. Hopefully it makes sense to you. I think it's pretty straightforward, okay? Now here's the 200% rule. Again, This is where you exceed the 3-property rule, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so here's how it works again. All right, so again, we sell for $1 million. Now, this time we go out and we actually identify 5 properties. All right, because we've identified 5 properties, what just happened? We exceeded our 3-property rule, right? So that puts us into the 200% rule. So what does that mean, right? Well, what that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, boy, where's he getting the $2 million from? All right, so we sold for $1 million, right? So 200% of the $1 million that we sold for, or 2 times that $1 million sales price of the property that we sold is how much? $2 million, all right? So that's where I'm getting the $2 million from. Now, I think that this particular rule, I think this is pretty straightforward. Hopefully everybody gets this one as well, all right? Now, here's the 95% rule. Again, this is where you exceed the 3-property rule and you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. All right, so here's how it works. Again, we sell for $1 million. Now, in this example, we actually go out and we identify 10 properties, all right, because we've identified 10. What just happened? We've exceeded our 3-property rule, right? Let's keep the math simple, too, in this example, all right? We're going to buy each one of those properties for $1 million a piece each, right? Now, we've identified how much in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened there? We've exceeded our 200% rule, right? Because that was how much? $2 million, right? So that puts us into the 95% rule. So in our example, let's just say we only purchase 9 out of the 10 properties. Okay, that's only 90%, right? Or $9 million. That's not 95%. Okay, if we do that, if we only acquire 9 out of the 10 properties, guess what happens? We blow our entire exchange and we have to pay all of the taxes, right? So the reality of the 95% rule is really 100%. Okay, of whatever you identify, you're going to have to buy. All right, we're using really simple numbers. We're just saying, hey, all the purchase prices are going to be an even $1 million. You know, those purchase prices, they're going to be all over the map, right? It's going to be really hard to sit down and say, okay, let's see. If I purchase this property, wait, that's only going to put me at 93%. Maybe I need to make sure I purchase this other property. Wait, that's only going to put me at 94%. The 95% rule, again, the reality of the whole thing, the way it works out is it's really 100%. All right. The IRS wants to limit you in how many properties you identify. All right. They don't want you going out there identifying everything under the sun, because you know what's going to happen if you identify everything under the sun? You're going to have to purchase everything under the sun because of this crazy 95% rule, all right? So again, it's very rare that we see anybody enact this rule, but it does exist, and I just want to make sure everybody is aware of it, okay? So hopefully everybody gets it. If not, hey, we can talk offline. Maybe we can, figure out some other examples if it doesn't make sense to you. All right, now, how does the whole closing process work with 1031 exchange? Well, we really don't start doing our thing until a contract gets signed on the property that's being sold, all right, the relinquished property, because the way it works is I need to get a copy of that contract, okay, and I also need to find out who's going to be handling the closing, because what happens is we reach out to that company, all right, and we're going to get from them a copy of the title commitment, the title search, the title binder, all right. Once we get that in, all right, the title search, the commitment, in the contract, and what happens on our end is we're going to turn around and we're going to prepare what we refer to as an exchange agreement, all right? And those are going to be documents that are going to set their 1031 exchange up, all right? We're going to email those over to whoever's going to be handling the closing, all right? The attorney, escrow company, title company, all right? Those documents are going to be sitting there waiting for the closing to happen, all right? Day of closing, those documents get signed by the seller, the exchanger, all right? We're actually going to step into their shoes as the seller the day of closing, okay? That's the way we're able to take the proceeds. Whoever's going to be handling their closing, they're going to wire those proceeds, the net proceeds, over to us, and we're going to hold them on their behalf, okay? So that transaction takes place, okay? And then the clock's going to start ticking, right? 180 days to close to purchase your replacement property. The first 45 days is what? The identification period, right? We're going to be sending out that identification ID letter. The client, the exchanger, they're going to be completing it, signing off on it, getting it back to us by midnight of the 45th day. Now, once they get a contract on their replacement property, all right, we're going to need to get a copy of that as well. We also are going to need to find out who's going to be handling that closing, right? Because think about it. We're going to be holding all the proceeds from this sale, right? We're going to need a contact person who's handling the purchase of the replacement property. We also need to get that company's wiring instructions, right? There's going to be some other documents that we're going to prepare that we're going to send over to whoever's handling that closing, right? Day of closing. They're going to sign those documents, the exchanger. We're going to step into their shoes as the buyer, okay? And that's the way we're able to take the proceeds that we've been holding since the sale, and we're going to wire those proceeds over to whoever's going to be handling their closing to help them purchase that replacement property, all right? That's it. That's the entire closing process, all right? It's not that complicated of a process when it comes to the closing, all right? Just everything leading up to it is the complicated stuff, right? Trying to figure out what you potentially want to buy by midnight of the 45th day, negotiating the contracts, figuring out do you need to get a loan, do you need to get cash, all that type of stuff is the more complicated stuff. But the actual closing process itself is the easier part of 1031 exchange, okay? Now, there's a few different type of exchanges, okay? Now, the most common type is referred to as a delayed exchange. Now, that's everything that we've talked about today, folks, all right? That's actually where you sell first. So you sell your relinquished property first, okay? Clock starts ticking, right? 45 days to identify, and you need to purchase your replacement property last. You're purchasing your replacement property, all right, by day 180, all right? You buy last, all right? That's referred to, again, as a delayed exchange. It's the most common type of exchange that we do. You know, I don't know, 90 to 95% of all the exchanges we do are delayed. But there's a few other type of exchanges, okay? There's one that's referred to as a reverse exchange, all right? It works just the opposite of a delayed, okay? It's actually where you buy first. You buy your replacement property first, and then you sell your relinquished property last. Okay, they can work something like this. Let's say you have your property listed for sale. Now, maybe you don't even have a contract on it yet, right? But you go out and you find that perfect replacement property. And you know, boy, if you don't act fast, you're going to lose out on being able to buy that perfect replacement property. Maybe it's a market like we have right now. It's a seller's market, right? Properties are turning over really fast. And boy, you know, if you're not able to purchase that replacement property, all right, before you sell your relinquished property, by the time you sell your relinquished property, that property may be sold. Okay, so what can you do? How can you save that whole deal? Well, you can do this thing called the reverse exchange. What happens in the reverse is we actually come in, we form a separate company. All right, it's referred to as an exchange accommodating title holder, EAT for short. All right, we come in and we purchase your replacement property before you sell your relinquished property. All right. Now, when we do that, all right, if that replacement property has tenants, okay, where there's rent money coming in, we can actually do a triple net lease back to the exchanger, the client, so they can benefit from any rent monies that are coming in. Okay. Now, when we acquire the replacement property, all right, you must be able to sell your relinquished property within 180 days. Okay, so there's the 180 coming back into play. All right, it never leaves. Okay, it's always going to be present. All right, it's just working the opposite way now. Now, what are some of the positives for a reverse exchange? All right, in a reverse. All right, when it's a seller's market, as I mentioned, hey, you have to act fast. You got to save the whole deal. Be able to get that perfect replacement property. Hey, do the reverse exchange now. What if you have a client like this? And I'm sure some of you all on the line have had clients like this. You know, they list their property with you, right? And they think, boy, my property is the greatest property in the world. I'm not going to have any problems selling it. So what do? They go out and put a contract on a replacement property. And then slowly but surely, what happens? Reality starts to set in, right? They slowly realize, boy, maybe I don't have the greatest property in the world because I'm not getting all those showings like I thought. I'm not getting all those offers like I thought. But guess what, folks? They actually have a contract on a replacement property, and that closing date is fast approaching. they're obligated to buy that property now, right? What can they do? Well, they can do a reverse exchange and save that whole deal. All right. Now, what's the biggest obstacle, biggest negative to overcome in a reverse exchange? Well, we're a great company, but we're not just going to come out of pocket and buy the replacement property, right? The actual client, all right, they need to be able to give us the financing to be able to do that. Now, typically, it's going to have to be cash. Okay. Why do I say cash? Because if they're trying to get a loan through a traditional lender, a conventional lender, typically lenders are not going to loan funds at that point, right? We're not the borrower, the client is, okay? We're going untitled, the client is not, all right? So traditional lenders typically aren't going to loan funds at that point, all right? Now, maybe they have some type of great banking relationship, right? Maybe they can get some type of line of credit, something like that. Some people tell me some of these hard money type lenders, they'll do deals like that all day long. For us, it doesn't really matter. Just some way, somehow, the client's going to have to be able to give us the financing to be able to purchase that replacement property. All right. Now, what's the other negative? Well, I kind of already mentioned it. You must be able to sell your relinquished property within 180 days, right? What happens if you don't sell your relinquished property within 180 days? Well, you're going to own two properties. Okay, you're not going to have any capital gains taxes or anything associated with the sale because why? Because you never sold anything, right? Now you can still do a 1031 exchange, because if you say, well, I still want to sell that investment property, hey, you can do that. Do a 1031 exchange, but guess what? You're going to have to designate a new replacement property because at that point you would already own the original replacement property, and with 1031 exchange, you can't exchange it to something you already own. Okay, so that's how a reverse exchange works. Now, there's another type of exchange. It's referred to as a construction exchange. Another common term you hear people refer to this is an improvement exchange or even a built to suit exchange. Okay, they can work something like this. Let's say you sell your relinquished property in a 1031 exchange, right? Now, we're the qualified intermediary, right? We're going to be holding the proceeds from the sale. Now, the client, they go out and they find a replacement property, but they want to do some improvements to it before they actually acquire it. So what can they do? Well, they can do this thing called the construction improvement, built to suit exchange, okay? We come in, we form that EAT, okay? But now we can take the proceeds that we've been holding from their sale, we can use those proceeds and we come in and we buy the replacement property with the proceeds from their original sale, okay? And then at that point, we oversee any improvements, any construction, okay? We're working with the contractors, the subcontractors. We're paying those subcontractors, the disbursements, okay, the whole boat, all right? Now, those improvements need to be done within 180 days. Okay, there it is again. It's coming back. Again, it never leaves. The 180 days is always going to be there. Okay, so that's how a construction improvement built to suit exchange works. Now, there's another type of exchange. I refer to it as a non-appreciation exchange, right? Now, sometimes you may have a client that says, hey, I bought my property in the height of the market. Now, I've owned it for years, but, basically I'm going to be selling it, and I'm selling it for basically what I bought it for. So on the surface, the client may say, well, I have no gain. I don't need to do a 1031 exchange. But what could the potential problem be? You'll remember depreciation recapture tax, right? That 25% tax. They're still going to be subject to that tax on any depreciation that they've claimed. All right. So here's a quick example of maybe the way that could work. Let's say the client says, well, okay, I bought my property in the height of the market. I bought it for $1 million. Now I've owned it for years. Okay. And now I'm going to sell it for $1 million. So again, on the surface, I say, well, there's no gain. There's no reason to do a 1031 exchange. But here's the potential problem. Let's just say during that time period that they owned the property, okay, for the lifetime that they owned it, they took $200,000 worth of depreciation, okay? So when they go to sell the property, they're going to be hit with a 25% depreciation recapture tax on that $200,000. That's going to equate to $50,000 in taxes when they sell their property. They can still do a 1031 exchange and defer the depreciation recapture tax, all right? So don't always think if a client's telling you, hey, I have no gain in the property, I don't need to do a 1031 exchange, just ask them. Say, look, have you talked to your CPA? Do you know your numbers, right? Because you don't want them to get to be in for a surprise when they sell their property, not realizing, hey, I've sold it. I could have done a 1031 exchange and deferred that depreciation recapture tax, right? Here's another thing, another example. If you ever have a client that is telling you the investment property that you're working with them on, that they purchased that in a 1031 exchange, but hey, they don't want to do another 1031 exchange on the sale. That should be a red flag, right? Because remember, a 1031 exchange is what? A tax deferral. It's not a tax avoidance, right? If they don't do another 1031 exchange, they're going to be subject to those taxes, and any of the taxes that they deferred prior, they also would be subject to those taxes as well. All right. Now, what do we charge? What do we charge? What are our fees to do 1031 exchanges? Well, on the delayed exchange, right? That's the most common type of exchange, right? That's where you sell first, right, and you buy last. All right. That's the most common type of exchange. We charge a flat fee. It's $1,000. Okay. That's for you to sell one property, okay, one investment property, and to purchase one replacement investment property, right? We don't charge our fee. That $1,000 fee is not incurred until it physically closes. So I just walked y'all through the entire closing process, right? We like to start doing our thing once a contract gets signed, okay? If all the documents, if the exchange agreement is waiting at the title company, attorney, escrow office, waiting for the closing to happen, if for some reason it never gets the closing, the whole contract falls apart. We don't charge any kind of cancellation fees, right? We don't charge any type of wiring fees, anything like that. Our $1,000 is not incurred until it physically closes, right? Just like you guys, if you're realtors, right? You don't earn your commission until it physically closes. Well, neither do we, all right? So that's if you sell one property, you buy one property, our total fee is $1,000. Now, if they happen to say, well, hey, I'm going to buy an additional property, an additional replacement property, no problem. If it's another closing, if it's another seller that would, a different seller, another transaction, it's another $250. Okay, but typically you sell one, you buy one. Our total fee is $1,000. Now, the reverse exchange. Okay, that's again where you buy first, you buy your replacement property first, and you sell your relinquished property last. All right, those start off at about $6,500. Right, those can be significantly more complicated than a delayed exchange, okay? We're forming a separate company. We're going on title, all right? Now, the construction, improvement, built-to-suit exchanges, okay? Those start off at about $6,500 as well, all right? Again, we're forming a separate company. We're going on title. In the construction, improvement, built-to-suit exchanges, I mean, we're working with contractors, right? We're overseeing construction, okay? I mentioned to y'all in the very beginning, one of our owners is a tax attorney, Adam Skarsgård. Adam personally handles any reverse exchanges, any construction exchanges that we do. He looks at each one of them individually and decides on how complex they are and bases our fee off of that. Okay? All right, guys. Well, that's it. That's the last slide. We're doing great on time. We got a few more minutes left. If anybody has any questions, okay, feel free. Type your questions in the box on the right-hand side. It's labeled questions. Go ahead and feel free to start typing your questions in. While we're waiting for the questions to come in, I'll mention this again to everybody. As I said in the very beginning, today's presentation was recorded, okay? You're going to receive a link with today's recording, all right? If you want to refer back to any of the topics that we covered, you'll receive a link. Also, I mentioned this in the beginning. Some of the topics that we covered today, I mentioned them here and there. I have various PDFs on those individual topics, okay? I'm going to email those out to everybody that attended today, all right? Some of my literature I even have in Spanish, and I have in Chinese. If you want those additional languages, please let me know. I'll get those out to you as well, all right? It'll be something really easy. If you're a realtor and you want to be able to forward something on to a client regarding 1031 exchange, you can pick and choose what topics apply to that client. Sometimes realtors will CC me on that same email, all right, that they're forwarding to them. Don't feel like you have to be a 1031 exchange expert, okay? I talk to people all day long about 1031 exchange, all right? I want to be a resource for you guys, okay? Just identifying if your client has a need, and I can take it from there, all right? If you individually have your own investments, all right, and you want to talk, let me know, okay? your clients, let me know as well. My name, my email's on the screen, my phone number. Feel free to shoot me an email, give me a call. It could be something as simple as, hey, I'm thinking about listing my property. I want to know what my options are with 1031 exchange, or it could be something as, hey, I'm closing tomorrow and I want to do a 1031 exchange. Can you help me out? Again, if they close and then they call me after the fact, it's too late. All right. So let me know. I want to be a resource for you guys. And I'll mention this too. Today's class was worth 2 continuing hours. Okay. I have 2 other classes that I teach. One's a basics 1031 exchange class. It's only an hour. It's non-CE. I also have another hour class. It's about an hour and 15 minutes, and it's an advanced 1031 exchange class. Again, that one's non-CE as well. I can do that, the basics, the advanced, or this class. If you think other realtors in your office would benefit, let me know. I'd be glad to do just a class just for your office. I do them for boards of realtors, individual real estate offices, title companies, CPAs, attorneys' offices. All right, just let me know if you want. I have some information I can send you. If you're the broker owner of the office, if you want to forward it on to your broker or owner, let me know. I'll send that out to you as well. All right, let's see what the questions are here. Okay, is there a video login? I think I just mentioned I'm going to be sending the link out to everybody, but that was X at 11:04. So probably maybe you joined a few minutes late. Are the slides available? Again, you're going to receive a link to today's presentation. The slides, I'd be glad to send y'all the slides if you want, but the slides don't have any backup. Some of them are just like bullet points. There's no explanation. But I can get them out to you if y'all want those as well. Like I mentioned, the PDFs, that's going to have everything you need to potentially send to a client, or if you're an investor yourself, it's much more easy to understand it. It's written in easy explained terms. Okay. Okay. Let's see. Tom has a question. My client has been using his property 6 weeks in a year and leasing it the balance of the year. How long must he not use the property to qualify for a 1031 exchange? So you've been using it for 6 weeks in a year and leasing it the balance of the year. Again, that I don't know if you had asked that before we covered the vacation homes. It looks like it was only 30 minutes into the presentation. I don't think we covered vacation homes, but the guidelines for vacation homes: own it for at least 2 years, 24 months. Use it for every 12-month period of ownership. Rent it out for at least 14 days at fair market value, at least. You can use it for 14 days for every 12 months or 10% of the total time, right? I mentioned when we were talking about that, if you don't meet those guidelines, okay, and it looks like your client's been uses it for 6 weeks out of the year. Okay, if it doesn't meet those guidelines for vacation homes, talk to your CPA. Have them talk to his CPA. And again, if the CPA and your client can come to an agreement where they feel like if he was ever to get audited, they could justify the property as being an investment property, then hey, use it in a 1031 exchange. Okay. Can a residential property that was lived in qualify? Yeah, it can. I think we covered that. Residential property was lived in. We talked about doing the combination of the 121 and the 1031. Okay, to qualify to do the combination, I mentioned you had to have owned it for at least 5 years, and you had to have lived in it any 2 out of the last 5 years. Okay, that's how you do the combination. Now, I didn't tell y'all if, let's say, you owned it greater than 5 years. Let's say you've owned it for 10 years. Okay, if you're going to sell it today, all right, it's an investment property. You're selling it today. You've owned it for 10 years. Well, what the previous 5 years, did you live in it as your primary any of those 5 years? If you did not, it's not going to qualify for the 121. All right, you had to have lived in it any 2 out of the last 5 years of ownership. Okay, but residential property qualifies for 1031 exchange. Commercial property, everything's interchangeable. Okay, we mentioned that with the qualifications of like kind property is. Okay, hopefully that answers your question, Joe. If not, let me know. All right, we can talk offline. spell the line source option. I can't find it. I'm not exactly sure what that means. Bridget, spell the line source option. Not exactly sure. I'm sorry. I don't understand your question. If you want to give me a call or shoot me an email, give me more information, I'd be glad to help you with it. Let's see. Steve's got a question. Business purchase only, or property and business together. It's only the real property. I think you're talking about when I mentioned you can sell real property that you use in your trade or business. I gave you all the example of a gentleman that owned a daycare center, right? Well, he was selling the entire business, the entire daycare business, all right? The real property, the actual real property that the daycare center is located in, that needs to be separated, all right, out of the entire purchase price, all right. So you have to be able to. You can only sell the real property. The business you can't sell that in a 1031 exchange, all right. 1031 exchange is only on real property, right. So the actual real property that you use in the business can be exchanged for other type of real property that you're going to use in your trade or business, or that you want to hold for investment, all right. I didn't tell you all this. I have a lady that is selling a daycare, all right? She doesn't want to be in the daycare business anymore. What she wants to do is she wants to sell the daycare, do a 1031 exchange, but she wants to go out and buy property on the beach, okay, investment property. She can do that, okay, but you have to determine what the real property value is in the business, okay? Hopefully that makes sense, Steve, hopefully. Let's see, what's the next question? Okay. All right. I don't know what that means, Steve, from the Bayou, but I'm not going to repeat that on the air. What class is this one? I guess you didn't join it in the very beginning. It's Discovering 1031 Exchange. This is worth 2 continuing ed hours. But hopefully everybody got that. This is the 2-hour class. It's not a basics class. Hopefully y'all understand that. And it's not the advanced class. It's a combination of both. It's the Discovering 1031 Exchange. I did see the vacation slide. Okay. Yep. I'm from New Orleans. I mentioned that in the very beginning too. That was the very first thing I talked about. You probably joined a few minutes late, but born and raised there. Okay, we'll go ahead and wrap it up today. It's 1:01, and we're 1 minute over, but I appreciate everybody sticking with us. It's 1:02 now. Hopefully you learned a little something today. Again, don't feel like you have to be a 1031 exchange expert. Again, I want to be a resource for you guys. If you have clients or you have your own individual investments, please let me know. I'd be glad to talk to you and talk to your clients. And if y'all want any of those slides in the various languages, Spanish or Chinese, please let me know. And hey, if you want to bring me in to teach a class for your individual real estate office, board of realtors, title companies, attorneys, CPAs, let me know. I have information that I can send you that talks about the various classes, gives you a description of the breakdown of all the classes, and I'd be glad to get that out to you as well. All right. So again, thanks everybody for joining today. Please stay safe, stay healthy, and hopefully we'll talk soon. Thank you. Bye-bye.